Hello, and welcome to Kathmere Capital Management's second quarter 2021 Market and Economic Update webinar. I'm Nick Ryder, the Chief Investment Officer here at Kathmere Capital. During today's webinar, I'll provide a brief look back on market performance during the first quarter of 2021, as well as touch on a number of key themes and trends on the minds of investors today. Diving in here, we have a brief summary of capital market performance, and we can see in the green bars during the first quarter, global stocks continued their upward march with U.S. international and emerging market stocks all up in the low to mid single digits. High yield bonds put some incrementally positive returns. Investment grade bonds and muni bonds both sold off ever so slightly during the first quarter as we had consistently rising rates through the quarter. And if you look back then on the blue bars over the last year, you can just take stock of what a remarkable rally we've had from last March's lows, with global stocks all up north of 45% over the year-over-year basis. High yield bonds, extremely positive returns of 23%, and even investment grade bonds notching some year-over-year positive performance. This slide just puts into perspective how strong the rally has been from the March 23rd lows of last year. So this is from Deutsche Bank, just presenting the performance of the S&P 500 on a rolling 12-month basis going back to 1930s. And you can see that with the S&P up 75% as of March 23rd relative to the previous March 23rd's lows. That was the strongest 12-month rally on the index going back all the way to 1936. Here we just present something that we've been talking about and looking at for quite some time now, which is a dramatic reversal in market leadership. On the left-hand side, we show the performance of a variety of indexes for the first 9 months of 2020. And what you can see is that while the S&P 500 was up 5.5% during that horizon, it was very much a growth-driven market, with a large cap growth index up just less than 25%, and the NASDAQ 100, another growth and tech-oriented index, up more than 30%. And you can see then large cap and small cap value were actually pretty significantly negative returns during that 9-month period. And that was really a continuation of a trend we had seen in place for the last 5 to 10 years, where it had been growth outperforming and value underperforming. The script really flipped back in October of last year and has continued over the last 6 months, where we've seen large cap value, and to a significant extent small cap value, dramatically outperforming over the last 6 months, and large cap growth and then again the NASDAQ lagging the broader market over the last now 6 months. This is a trend we expect to continue, probably certainly not to the degree of which we've seen over the last 6 months, but it's something that we continue to remain pretty optimistic for the prospects of value stocks going forward. Turning now to the economy, we look at GDP, year-over-year GDP growth on this slide, and you can see after last year's 3.5% contraction, the broad economy is expected to grow at a historic clip in 2021. Here we just plot the forecast from the Federal Reserve, calling for growth of 6.5% on a year-over-year basis in 2021. You look at some private market private forecasts, they call on for growth north of 7 in a lot of instances, and you can see strong growth that continued in both 2022 and 2023, as well as we kind of approach more towards a trend level of growth in the years out. Broad takeaway here, economy continues to recover and strong growth ahead. Of course, one of the significant drivers of the strong economic growth, and we think about a GDP figure here, has been the exceptional amount of fiscal stimulus added to the economy over the last year. And so we present here a number of the major stimulus bills and measures enacted over the last 12 months. And you can see that in 2020 alone, we saw $3.7 trillion of stimulus efforts. That was a little bit more than 17% of 2019 total output. The recently passed $1.9 trillion stimulus bill under the Biden administration, that was a further roughly 9% of GDP. All in, over the last little bit more than 12 months, we've seen $5.6 trillion of stimulus efforts enacted. Add that all up, and it's more than a quarter of the previous year's output. Just to put that into perspective, you can see that we are orders of magnitude larger than what we did see from the stimulus signed by President Obama back in 2009, which was a little bit more than $800 billion, or 5.5% of GDP. And so just a really unprecedented level of fiscal stimulus pumped into the economy over the last 12 months. This has had the result of really putting the U.S. consumer, the U.S. household sector into a great position. When we think about the amount of cash that was dispersed directly or indirectly to households over the last year, what we see here on the left-hand side was personal income rose by a little bit more than 6% in 2020 relative to 2019 levels. The green bars show earned income was roughly flat, but then government transfer payments, of which stimulus checks, expanded unemployment benefits, enhanced unemployment benefits, all are lumped in there. That really drove the year-over-year growth, but all told, you did see a 6% year-over-year growth. Meantime, look at the blue bars. We see personal consumption was roughly flat to a slight decline on a year-over-year basis. As a result, you saw personal savings really skyrocket in 2020 to the tune of about $2.9 trillion of income that was earned was not spent. This went pretty, by survey measures or some estimates, roughly a third to paying down debt, which is a positive for the future as households more resilient, have lower financial obligations going forward. A third of it roughly likely used to purchase financial assets like stocks and bonds. That certainly probably contributed to the strong stock market and bond market rallies last year. And another third really set aside by households in checking, savings, deposit type accounts, probably earmarked for future spending. And so that's where we look at, and a lot of economists will talk about, a lot of cash to spend among the household sector and a lot of pent-up demand that as households or consumers feel comfortable going out spending, or as economic restrictions get lifted, we are likely to see a pretty significant boost in consumer spending as we look into 2021. Here we look at the labor market. Couple measures of just looking at labor market health. Broad takeaway here is that labor market continues to heal, but we're still a bit away from full employment. We can see the headline unemployment ratio has dropped down to 6% as of the March 2020 reading. It's a bit higher than the 3.5% rate we saw in February 2020, but nevertheless progress being made. A broader measure there in the purple line, the underemployment rate coming in at about 11% now versus 7% a year ago. So again, recovery, but still some way to go. The very broad employment to population ratio, we look at about 58% today versus 61% a year ago. But really probably the easiest and most simplistic metric, just look at total non-farm payroll employment. We see today through March of 2021, 144 million people employed. Compare that to a little bit north of 152 million a year ago. We see that the economy in aggregate is about 8.5 million or so jobs shy of where we were at what could arguably be considered full employment a year ago. Look at then the bottom right-hand side, and you just see breaking the change in employment by various wage groups divided by the top third, middle third, bottom third, and you can see what's been getting some press coverage is that most of the job losses yet to be recovered really do remain concentrated in the lower income portions of the economy. And so you take kind of those two bottom charts, 8.5 million jobs still to recover, a lot of the job losses still being borne on the lower income cohorts of the economy. And that's where a lot of the impetus has been in why there are many out there arguing that more stimulus or ongoing stimulative measures from both fiscal as well as monetary policy are warranted to ensure that the labor market does continue to heal and that it is a broad-based recovery. We look here just now turning to government spending. Next few slides, we'll look at the government sector. Plotting here the red and kind of reddish lines, look at spending both under current law as well as under the Biden administration's plans. What you can see is that last year, of course, we saw a significant spike in spending to levels as a share of GDP not seen since the World War II effort. Under current law as well as Biden's spending plans, you do see spending likely to remain at historically elevated levels in the next decade as kind of increased stimulus programs happen, as well as many of those are looked to be turned into permanent expansions of social programs. Looking there then, the blue lines, we look at the flip side of spending, but the tax revenue coming into the federal government. You can see really spending today and anticipated over the next decade more or less likely to remain in line with historical averages, somewhere probably between 15 and 20% of GDP, but a pretty considerable, call it roughly 5% gap to as a share of GDP relative to spending. What that is, of course, is spending minus tax revenue shows us the deficits from the federal government year over year. And what we saw last year for fiscal year 2020 saw the federal government run about a $3 trillion deficit. This year's deficit expected to eclipse last year's, likely projected to be in the range of roughly 3.4 trillion. And even over the next decade, deficits are projected. Annual deficits averaging about 1.5 to 1.6 trillion. The CRFB estimates that deficits will average about 4.5% or so of GDP over the next decade, and in total aggregate to about $16 to $17 trillion of total deficits over the next decade. As you can see, they're roughly in the $1 to $2 trillion per year looking forward. As a result, deficits need to be paid for somehow, and the way that's been done is through increased debt outstanding from the federal government via the Treasury. And what you saw was Treasury debt or federal government debt outstanding held by the public eclipsed 100% of GDP last year, and that number just expected to kind of incrementally increase as a result of the ongoing deficits as we look over the next decade. Advocates for the deficit spending will point to this chart and suggest that, hey, when we look at the labor market and the need for continued recovery there, that more needs to be done, and not needing to worry about deficits today. The argument being that the cost of servicing the debt or the deficits remains actually below average. We see right now the interest expense on the federal government debt is about 1.6 or so percent of GDP. That's actually below longer-term averages plotted there by the blue bar, and actually is still pretty significantly below the levels realized in the 80s and 90s when, while the debt burden was considerably lower, interest rates were considerably higher. A lot of economists that talk about or advocate for the deficit spending have kind of pointed to a rule of thumb that says, hey, so long as interest expenses remain below 2% of GDP, there's not much cause for concern. Detractors would say that's a naive or flawed way of looking at it, arguing that, for one, it's not guaranteed that interest rates are going to remain low, and that if they do, that could put us into a tricky situation. Is probably the best way to put it. And B, detractors would point to and say, even setting aside the ongoing carrying costs of the debt, we do need to recognize that debt eventually does need to be repaid in one form or another in the future, and that'll either need to come to roost at some point, and that by addressing the issue sooner rather than later, we're able to make sure that we're less susceptible to negative shocks in the future. So this will certainly, I think, debt and deficits and interest expense are something that are going to continue to gain attention of investors and economists everywhere. One thing we've seen as the government has run its massive or significant deficits over the last couple of years, you've seen monetary policy remain highly accommodative via zero interest rates, as well as the Fed buying up the federal government debt to keep interest rates low and to keep liquidity in the system. What you've seen, the combined result of that is a significant growth in outstanding money supply. So here we present the M2 money supply. You can think of this as really a broad measure of outstanding money, which is in the form of cash outstanding, as well as checking, savings, account deposits, as well as retail money market funds, or think everything that's daily liquid, readily liquid cash and cash equivalents to be spent. And you can see that over the last year we saw that increase by more than 25% on a year-over-year basis, which was the largest such increase on the history of the data going back to the 1960s. What this massive increase in the money supply has led to is cause for concern among certain segments of the investor populace, and as well as economists, of fears for inflation making a significant return. And so here we plot both the 10-year Treasury bond yield in the green line. We can see that has moved measurably higher over the last 12 months, coming from roughly 0.5% during the March of 2020 lows, and it has now reached its way up to north of 1.75%. So pretty significant move higher over the last 12 months, but certainly nothing that we haven't seen before. You can just look back over the last decade, and you've seen multiple rises of the 1 and 1.5% range in the Treasury rate. The fear is that this will continue to move higher in the months ahead. The inflation there we present in the dotted purple line via the core PCE inflation metric. This is the Fed's preferred measure. The Fed has stated its goal is for inflation to run over the long term at about 2%. We see today we're still running below that, as we have for much of the last decade. Very, very infrequently do we ever see inflation on a core basis eclipse that 2% threshold. The Fed and Chairman Powell has been very clear that the Fed intends to allow inflation to run a little bit above that 2% metric for some time if need be, to ensure that the labor market continues to recover, that those lower income segments of the labor market fully recover jobs. And so I look at this, I think rising inflation is something certainly that we're going to need to contend with. I don't think that we should be prepared or bracing for a return of double-digit inflation a la the late 1970s, early 80s. However, I do think investors need to brace themselves for inflation to run a bit higher than we've probably become accustomed to in the last decade plus. I think it's totally reasonable to expect inflation in the 2 to 5% range in the near future. And it's something that we're going to continue to watch and monitor closely for signs that inflation expectations might be coming a little bit on board, and that maybe inflation could even move higher than that. But certainly a key source of risk in markets today, something that we're watching intently. Here we're just showing, as additional kind of detail, a number of signs that inflation pressures are in fact mounting. Just looking at the manufacturing sector here, we've seen, as a result of supply chain backlog or constraints, impediments, whatever we want to call them, we've seen delivery days are up, backlog of orders are up, inventories are down, the prices paid in manufacturing up. All of these would kind of suggest and paint a picture of expect rising inflation pressures in the months ahead. We've talked about corporate debt here. I just want to kind of quickly call out another cause for potential concern, or a yellow flashing light in markets, is rising corporate sector debt, presented there in the blue bar. You can see that over the last decade, you've seen kind of a steady increasing leveraging of the corporate sector, really exacerbated last year as companies issued historic amounts of debt, both in investment grade and high yield bonds, to really shore up their balance sheets with liquidity during the crisis. And so you've seen really spiking now to a modern time high in terms of corporate sector leverage. We talked about previously, obviously, the government debt there in the red line at all-time highs as well. And then if we look there, one positive, what I would say is the household sector, as we've alluded to, in quite strong position right now. You've seen the household sector since the height of the real estate bubble back in the mid-2000s has consistently deleveraged over the last decade. That has made households much more resilient, much lower debt service obligations going forward, and certainly a cause for optimism when you think about ongoing economic recovery, is that the household sector is in such good shape. But that corporate debt in particular is something that we're continuing to watch as we think about a potential risk to the economy and financial markets broadly. Related to this is just what we've seen, or called the rise of quote-unquote zombie companies. So zombie companies, by this definition, are those companies where interest expense over the last 3 years have exceeded operating profits. So you think about basically they're kind of the living dead are walking along, just simply making enough money to pay off their interest obligations on their debt, but not necessarily returning much to equity shareholders. And you can see that that's been on a steadily march higher, to the extent that about 15% of the 3,000 largest stocks in the U.S. market today are zombies by that definition, a level really not seen since the height of the dot-com bubble, kind of the last speculative burst we saw in the financial markets. Here we've seen or see a chart just from Vanguard, which highlights what I'll call the rise of speculative activity in markets over the last number of years. And what we're showing is the percentage of IPOs that come to market, new IPOs that come to market from companies with negative profitability or unprofitable companies. And you see about 80% of IPOs in the last couple of years have all been from companies with earnings per share below zero. We look at this as just one sign of many of increased appetite for risk among investors, or investor willingness to look many years out into the future when pricing, both of which are kind of hallmark characteristics of late-stage bull markets, or bull markets with increased appetite for risk and speculative activity, and something that we think it's just important that investors be mindful of the activity and behavior of those around you, and hopefully position portfolios accordingly. what we've seen in such an environment, which is really a historical anomaly here, is over the last decade now, we've seen lower quality, highly expensive stocks have dramatically outperformed the market. This is a chart from Vanguard again showing low quality growth stocks delivering significant outperformance over the broad market over the last decade, exacerbated really in 2019, 2020. On the flip side, you've seen high quality value companies actually lose money on average over the last decade and dramatically underperform the broad market. Now, we've seen a couple slides ago or at the outset that perhaps this trend has started to shift, but it's really incredible when you put it in this stark contrast of what's happened over the last decade, where it has been kind of flipping historical trends on their reverse, where you've seen, again, low quality growth outperform and high quality value underperform, something that we don't think is sustainable. Maybe the cycle has started to turn, something that we would expect eventually to reverse back to historical trends. And I'll kind of conclude here then with what I'll call a cause for optimism for globally diversified investors, or those that can be disciplined and lean against the wind, as I like to say, in what I call our then and now chart. And what we're looking at is just looking back at a past example of a speculative driven rally where you saw large cap growth or speculative oriented stocks dramatically outperform for an extended period of time in the height of the dot-com bubble, and then what happened in the 5 years after. So on the top chart, we look at leading up to the height of the dot-com bubble, or the peak of it, which peaked in February of 2000. The 5 years leading up to that, so go from March of 95 through February of 2000, you saw in the gray bars, large cap growth outperformed the market by about 5% a year during that 5 year stretch. Large value, small value, international value, all lagged pretty considerably. Look at the next 5 years, they're depicted in the green bars, and what you see is that while the market as a whole delivered negative returns on average in the next 5 years, a lot of that was very much concentrated in large cap growth, which was down 10% per year during that horizon. On the other side, for investors that had leaned against the prevailing wisdom of a growth-driven market and had much more heavily allocated towards value and international stocks, the next 5 years was, yes, a lower return environment, but still a positive return environment. You see large value up 7.9% a year, small value up 16% per year, international value both up in the mid and low single digits per year. So we look at that as not a perfect roadmap for what we expect going forward, but certainly something that rhymes with what we could expect. And so at the bottom, then we look at what's happened over the last 5 years up and through September of last year, and then what's happened over the last 6 months. And you can see very similar trend where large cap growth outperformed by 6% a year in the 5 years leading up to September. Large cap value, small value, international value all lagged pretty considerably relative to the bull market or relative to the large cap growth in the broad market. A lot of people have been writing off value as dead or a bygone of a different era. We don't think so. We look at this and say, next 5 years, we expect good things from value stocks and international stocks and maybe a bit of a reversion to the mean. We've started to see that trend emerge over the last 6 months, as we pointed out earlier, and you just see some dramatic outperformance for both large, small value, as well as international value relative to the broader market. We think there's still a lot of legs left on this rally for value stocks, and so we do think investors who can afford to lean against the wind over the longer term recent past winners and into the recent, comparatively speaking, losers do have some opportunity for some good positive growth in the years ahead. So with that, I thank you for listening in today. If you have any questions on any of the content covered, would like a copy of the slide, please do not hesitate to reach out to either your advisor or to me directly, and we'd be happy to chat with you further. Thank you very much.